Sorry, guys. I was interrupted in the middle of that discussion by my memory expiring. So I had to clear some memory in my cell phone so that I could continue. But before, and so you're going to pick up on another video. You'll see the first one, and then you'll connect to the next one that picks up where I left off. I was talking about explicit versus implicit costs. And explicit costs are, for lack of a better explanation, the costs that the firms actually pay, right? So if the firm has to pay for labor, right, wages, that's an explicit cost. I say, oh, sure, yeah. Um, yeah, that makes sense. That's an explicit cost. It's explicit. The firm actually writes a check or makes a payment to its workers for labor, for health insurance for those workers, taxation that they pay are costs at the firm, rent that they pay is a cost that the firm incurs. So then you might be thinking to yourself, besides thinking, when is this video going to be over? You might be thinking, well, gee, kind instructor, what's an implicit cost then? An implicit cost is a cost, for again, lack of a better explanation, that you don't actually explicitly pay but still incur. Oh my goodness, kind instructor. That seems a bit confusing. What are costs that you don't pay explicitly but incur? Well, if you remember way back when Mr. Spinola taught you about opportunity cost, what you give up when you get something, basically that's what implicit costs are. The opportunity costs of conducting business that are not explicit payments. For example, a good example of an implicit cost is the opportunity cost of the entrepreneur's labor. So who's the entrepreneur? The entrepreneur is the person that starts the business, right? So let's think about that. Let's say that I worked at Cochrane, Subaru or Cochrane Pontiac or one of those car dealerships, and I was in a mechanic. And I said to myself, well, gee, I'm making, you know, $60,000 a year, and I have $10,000 and $15,000 in benefits. So my total compensation being employed here is about $80,000 a year. Oh, okay, I've had enough. I'm going to quit this job and I'm going to open my own auto shop. Well, okay. I open my own auto shop. What does it cost me? Well, it cost me the $80,000 that I gave up to open the shop, right? That's a cost, right? What if I took money out of the bank in order to buy equipment to start the shop? And the money that I had in the bank was getting 5% interest. Well, what did it cost me, right, to get that money to buy the things for the shop? Well, it cost me 5% on that money. So let's say I had $100,000 in the bank and I said, well, I'm going to take it and I'm going to open this business and I need all of this stuff. And I'm going to buy all of this stuff, which are all explicit costs. But now the $100,000 that I had in the bank, I got 5% interest on, which is $5,000 a year. I'm giving that up in addition to 85,000. Right? So you might be saying to yourself, if you're thinking about this, but I'm sure you're not, but if you were, you might be saying to yourself, well, gee, I mean, these aren't really costs. Sure they are. Because you make the decision based on really profits that are calculated including implicit costs. So if we were doing this, what we would say is, well, look, okay, let's take all the explicit costs that the firm incurs by doing their business, and let's add the implicit costs, the cost of the entrepreneur's labor, the cost of of the capital that was given up to start the business, the cost of rent foregone and capital foregone and profits foregone. All of this is discussed in chapter 7 in your textbook. And let's calculate those all and put them together. And now we'll have a total cost and we'll subtract that from total revenue. And what we'll get is economic profit, right? Now, this is ridiculously important, economic profit. Now, I should tell you, right? Let me repeat it. Economic profit is when we take the total revenue minus all of the costs, implicit and explicit, right? And what we're left with is what we call economic profit. Now, economic profit is ridiculously important because that is the profit that people make decisions on, particularly the decision to enter or leave businesses. Now, if you listen to the news, oh, that's a good one, huh? You kids listening to the news. That's a funny one, isn't it? But if you listen to the news or read the newspaper, wow, there's another thing. But if you listen to the news or you read the newspaper and they announce a firm's profits, they're never economic profits. They're always accounting profits, right? They're always accounting profits. They're never economic profits. But nevertheless, even though they're rarely reported, decisions are made primarily on economic profits. So one last thing about this. Is it possible that you could make an accounting profit? An accounting profit would be just counting the explicit costs, not the implicit costs. Economic profits count both implicit and explicit. Let me say that again. Right? Write that down. Oh, if you are taking notations, write that down. Write that accounting profits are total revenue minus explicit costs. Economic profits are total revenue minus explicit and implicit costs. That gives you economic profits. So what's always going to be bigger? Accounting profits. Accounting profits are always going to be bigger than economic profits, right? Because you're adding costs, right? So is it possible you could make an accounting profit and break even economically? Yes. You can make an accounting profit and an economic loss? Sure. What if the guy opens his business and he only makes $40,000 a year? He's making $80,000 before. So he's actually making an economic loss, right? Now, one last thing. One last thing. I promise you. Then I may be back someday soon. But this is the last thing. So with this notion of costs, right, in place, that we're talking about implicit and explicit costs, now we turn to another issue. The difference between long run costs and short run costs. And that takes us to a definition of the short and long run. In microeconomics, the short run is defined as the time period in which capital is fixed. Now, you could write that down. It's in your text. You probably should. Let me say it again. It's the time period in which capital is fixed, right? Now, you might say, kind instructor, what is capital? Capital is buildings and machinery. So in the short run, the firm, the business, has a fixed amount of buildings and machinery, right? That means there's a capacity, a fixed capacity of how much the firm can produce. That's the short run. Now you might say, how long is that? It depends. It depends on the industry. If I have a lemonade stand, the capital might be the picture that the lemonade is in, the table that's there, right? I can change that and, go get another picture and expand the table in 10 minutes. Then the short run might be 10 minutes. But if I'm U.S. Steel down at the Edgar Thomson Works and it might take me 10 years to expand the productive capacity, then the short run is 10 years. So whatever period of time it takes to expand productive capacity, to alter the capital, right? That period is the short run. In the long run, productive capacity is not limited. It can change. You can expand it or contract it. Right? Now I'm going to stop there. And hopefully you'll watch, both of these videos. If you start with this video, you got to go back and look at the other one, right? And because I was cut off right in the middle of it. So I hope that this is helpful for you, and I'll be back to do others.